Hi guys, good afternoon and welcome to Mutual Fund Corner. I'm Pavitra Parekh. With me is Sonal Bhutra. And Sonal, we talk so much about picking the right fund, how you should go about it, when you should get into the markets. But just as important is, when you should review your portfolio and when you should really get out of your investments as well.
It is as important as getting into the market, right? So as we say, timing is not easy, but of course reviewing is, right? That is something that we can make a habit. And to discuss all of this and when you should be reviewing your portfolio, when should you redeem your mutual fund investments, let's welcome Mrin Agarwal, who is the financial educator and director at Finsafe India. Mrin, good afternoon. Thank you so much for joining us. As Pavitra was mentioning, we often talk about getting into mutual fund investing, but once you do get in, how often should you be reviewing it?
So good afternoon, Sonal and Pavitra, and thank you for having me on the show today. I think a review once a year is a good idea. I think anything more than that, and nowadays, you have all NAVs and all your portfolio updated on a real-time basis available on your fingertips. But I think if you check it too often, it really might lead you to taking some wrong decisions because you might, and I was reading about this, that there is this research that actually says that the more often that you look at the portfolio, you see losses more than you actually see gains. And that's what gets you to take some very wrong decisions. So I think once a year is always a good bet.
All right, once a year is a good bet, and it sounds doable for everyone, right? Even if you're a new investor in the market. Mrin, but let's get a little bit more into it. What should you check when you conduct a portfolio review? Take us through some factors that you would, look at. Is it the category average? Is it, how it's performed versus other funds? Has it stuck to its strategy? What are the things that you look for when you conduct a portfolio review?
So I think the first thing would be to see that on an overall basis, what's been the portfolio return? How is it really done with respect to, how have the individual investments done with respect to, let's say, the category average or the benchmark returns? I think one factor that a lot of people do not consider is the portfolio beating inflation or not? And I think it's very, very, very important to check whether your portfolio is beating inflation or not. Finally, as you've said on the show many times, and I've said many times, that it's really important to invest as per your financial goals. So if you've actually done that, one of the things to actually also check is that how much of your goals have actually been already achieved in this financial year. So, so performance, are you beating inflation? How are you doing versus benchmarks, of course, is important. And at the same time, how much of your goals have you achieved?
Okay, so we assume someone has reviewed their portfolio, but after that, how should they look at redeeming their investments? When should this be done, Brin? What are the key triggers that investor should be looking at?
Well, of course, point number one is in case of emergency. But even when you have an emergency, it should be only debt funds that you're redeeming. I mean, ideally, you would not want to look at equity funds for such a reason. And that's the reason that one says that you should have an emergency fund. But if you don't have it, or if it's not adequate, then obviously you can look at redeeming some of your mutual funds. Of course, if there is underperformance, and how do you check underperformance? Underperformance relative to the benchmark, relative to the category average. You cannot look at your fund on its own and say, oh, it's down 20%, so I just want to exit this fund. Of course, if you're close to a goal, it's important to look at redeeming, especially if you're in an equity fund and moving out into a safer investment. Rebalancing of portfolios. So let's say it's been a great year for the markets and equities have done exceedingly well, but your asset allocation changes. That's another reason to look at exiting. And if there is a change in the fund objective or change in the fund manager, that could be another reason to look at exiting a fund.
Okay, those are some reasons that you can, consider or look at, and perhaps that's when you should conduct a portfolio review and see whether you want to get out of those investments or not. Mrin, I want to delve a little bit deeper into one of the points that you mentioned, and that is that, say, for example, you have met your financial goals, right? I'm going to present an example here. For example, I've met my I've met the kind of investment that I needed for my financial goal, but my financial goal is still a couple of years away. what do I do in this case? Because if I've, created the wealth that I wanted for it, I may not want to leave my investment hanging in something like equity, which could actually see the losses dwindle as well. So do you think in this situation, maybe you should try to safeguard the wealth that you've created, move to a less risky fund, less risky category than equities?
Oh, yes, absolutely. I think you should. And let me give the example of March 2020, when markets fell. At that point, for some of the funds, the 5-year SIP returns had fallen to almost nil. I think at the start of the year, let's say the return was about 10% CAGR, and you're looking at nil returns in March 2020 because of the fall in the markets due to the whole COVID situation, right? And it's a different thing that, those returns bounced back pretty quickly by the end of the year. But the point is that for someone who needed the money at that point in time, most investors were like, I've invested for 5 years, and yet I'm kind of having to exit at a very low return because of the market situation. So it's very difficult to predict what's going to happen in the market. And if you've made that return and that amount that you need for your financial goal, you should certainly look at exiting and moving on to a safer instrument.
Okay. So what do we do in case some investors' fund is underperforming? How long do you wait before deciding to get out or shift to another fund? For example, 2020, right? You can't predict the markets, but if it is underperforming, how long should one wait for?
Well, I think you should monitor performance for 12 to 18 months. I have seen many large funds also underperforming for extended periods of time. And also, if you see the data, something that was very well performing 3 years back, 3 years hence, it's really not even in the top 10 funds. So all funds do go through cycles. What is really important is, first of all, do not go only by recent performance. You need to keep tracking fund performance, again, on a relative basis, relative to category average, relative to the benchmark, of course, and see what is the reason for the underperformance. And certainly you need to do this for a 12 to 18 month period. One of the other things that's really important is also to look at it from a rolling return basis as well, to really see, where the, and really see where the issue is lying. So, yes.
All right, that makes a lot of sense. Mrin, another space that I want to ask you is about sector or thematic funds. I was having a very interesting chat on this just last week as well. This is a more risky space anyway, right? Because you're essentially betting on one sector or one theme doing well. Say you have put money into this and then your fund consistently underperforms. What do you do at this point? Do you just, get out, try to sort of save what you can, or do you try to look for the next opportunity? How long do you keep the faith? Because this can be a game that really tests your patience as well, right?
I would say cut your losses, because, thematic and sector funds are something that should be anyway kept away from. It doesn't really make sense because you really don't know when this theme is going to play out. And even if the theme plays out, you don't know if, the stock performance is going to be good. Case in point is pharmaceuticals, right? 2020, you saw the whole pharma sector doing well, but look at 21, 22. As a sector, it has underperformed, right? So I think it's not worth it to be in these funds, and I think it's just better to cut your losses.
On this topic, I was talking to Kalpesh as well last week, Mrin, and he was also saying that if you are going to be deciding that one sector is doing well, or you're essentially, timing it, right? You're saying that I'm getting in right now, I expect it to do well over the next 1-2 years. And he said if you are someone that knows that much about the markets, then just go the direct equity ways. There's no point to get into sector funds. But that's just one opinion, of course.
Of course, opinion makes the market, right? So, of course, we keep getting these expert opinions for all our viewers as well. But for now, Mrin, please hold on. We'll take a quick break, and on the other side, we'll continue this interesting discussion on redeeming mutual fund investments. Stay tuned. Welcome back. Still tuned into Mutual Fund Corner, and we still have with us Mrin Agarwal of Finsafe India to discuss when investors should be redeeming their mutual fund investments and reviewing their portfolio as well. We have discussed a lot of reasons why one should go ahead and redeem their investments, but another reason can be when there is portfolio rebalancing as well. Investors can sometimes find their asset mix altered also because of varying returns by different assets. So can you explain this for our viewers? How does the equity debt allocation change, and how often should you monitor it in that case?
So I think the first thing is, of course, how do you set this allocation, right? The equity and debt allocation. It's a question that I get very often. And it has to be really based on what are your goals, and what is the sort of risk that you're willing to take, right? So, for example, if you've decided that I want a particular allocation, let's say I've decided 60% bonds and 40% in equities, right? So that's what your equity debt allocation is. So now, ideally, again, this should be part of the portfolio review as well, which happens once a year and not really before that, irrespective of what's happened to the market. So even if the markets have run up a lot, I would still say that, do this as a part of the annual review itself. And you need to decide a number beyond which you are not comfortable. Ideally, I will say that if the allocation has moved plus or minus 15%, is the time when you should look at doing something, not really below that. Like, let's say, your equity portfolio from 60% has just gone to 65%. I don't really think that you should rebalance. Typically, if a 60% equity portfolio has gone to 75%, then maybe you look at doing some amount of rebalancing, right? So that number, you have to decide what is that number beyond which you want to really do the rebalancing or not. I mean, ideally, it's always good to do rebalancing as good portfolio management. There are people who also decide that they're okay with taking higher amount of risk, in which case they're really deciding to follow a more risky asset allocation strategy. Now, there are 2-3 ways in which you have to do the rebalancing. So let's say you decide to exit some investments. So here are a couple of things that you have to do on the equity side first, right? So first thing is that I generally see people have a tendency to have a lot of funds. They typically have like maybe 10 or 15 funds. So certainly, I think you should use this rebalancing time as a time for consolidation and reduce the number of funds. You can start by the funds that you want to basically redeem. Could be the ones where you have a very, very small allocation, for example, or of course, underperforming funds. If you have too many funds of the same type, so often I see people have like 2 or 3 large cap funds, 2 or 3 flexi cap funds, or 2 or 3 Nifty index funds, right? It's all investing in the same place. So if you have 2 Nifty index, 2 large cap, it's all investing in the same index. So you really need to look at reducing and consolidating into maybe one fund that's got exposure to large caps, right? Another thing that I see that people tend to have from the same fund house, a couple of funds. So they'll have a large cap fund, they might have a mid cap fund from the same fund house, or they could have a flexi cap and a mid cap fund from the same fund house. So what happens due to this is that, again, there could be overlap in stocks. There would be overlap in style of management as well. And hence, I think it would be good to basically reduce the allocation to that particular fund house. So couple of ways, do it once a year. Secondly, look at exiting small holdings, look at exiting underperforming funds, look at exiting funds where there's a lot of overlap of stock because you're holding similar type of schemes or you're holding similar types of fund houses.
All right, that is a complete explainer, and I'm sure that'll help our viewers a lot. Mrin, another question that we get very often is that what an investor should do when a fund's investment objective changes. So say you've invested because the fund strategy is something that works for you, it aligns with what you think, and then that strategy changes. What should you do in that case? Do you immediately get out, or do you keep the faith in the fund manager? So many of these fund managers are so celebrated that you can sort of be led to think that you should perhaps just stick with it.
So I would say that in case of fund manager changes, I would say that I think you should stick on for some time and really monitor and see how the performance is doing and take a decision based on that. But if the fund's objective changes, so I think this happened at the time of reclassification that happened a couple of years back. If the fund's objective has changed, then certainly you have to see whether it is going to be meeting your risk profile or not. Basically decide based on that what you want to basically do. So for example, if you were in a fund and let's say it got merged with another fund and it got merged with a fund which has higher amount of risks, for example, let's say a credit risk fund, if you don't want to take that amount of risk, then you basically need to look at exiting that fund. The good thing that happens in these cases is also that if it's happened due to a fund merger, typically they actually, I think, tend to waive off the exit load. So certainly, if that is the case, it doesn't tie in with your risk, you should certainly look at exiting.
Okay, so when we are talking about risks, since we see micros and macros changing, similarly, risk profile can also change. Say because of some unforeseen event, you need to move from a high risk to a low risk approach. Can you detail in that case what would the equity debt position one can have for a low, medium and high risk profile?
So, typically one sees most portfolios in India have like 5 to 10% of equities, and that's about it. Here we are taking examples of 60-40, but, very rarely do I actually see people wanting to have that sort of exposure. But I will just say this, that I think, people need to, a very easy way for people to figure out, what is the sort of equity debt exposure that they want to have is based on how much risk they can take. My classification would be that if you want to take low risk, I think it's really important to have, in today's time, at least 30% exposure to equities. I mean, that's the bare minimum that I would say. And 70% in allocated in debt. For somebody who's medium risk, of 50-50 is good. And for somebody who's high risk, I would just turn it around and say 70% in debt and 30% into equities.
All right, we have that chart up on our screen as well. So I'm sure that's useful for anyone to understand where they stand in terms of their risk profile, and then they can decide what the debt to equity split should really look like. Mrin, one final question on ELSS. A lot of money in this category really gets churned in 3-year cycles, right? Just because there is that lock-in. Is this a good way to approach it? Or, do you think that you should still treat it as any kind of long-term investment? It is an equity investment at the end of the day, right?
Yes, it is an equity investment at the end of the day. So certainly, I think it's really important to treat it like you would treat any other equity fund, and at least have a 7-year holding period in this particular fund. Many times we get queries saying that my ELSS is underperforming and stuff like that, and there's no option to exit. And I think, again, there is this big tendency to keep comparing returns in the short term. So given that there is anywhere a 3-year lock-in, I think you should just invest it and forget it for the next 3 years. I think, what is also important is, because, since you mentioned ELSS, I just want to say this point that I do see people trying to choose a different ELSS every year. And I think one of the main things, while choosing funds, and so that you choose right, and so that you don't have this, you don't have to think about redeeming it because of underperformance, is to actually look at funds which are giving you consistently good returns on the long term. So look at consistency over some great near-term performance. I think it's really important to look at long-term consistent returns, which you can actually do through rolling returns. Unfortunately, there are not too many sources where you can find this, but yes, that's the right way to go about it.
So that's the reason why we get experts like you on the show, right? To guide our viewers as well when it's needed to look at a particular fund in a particular way as well, especially ELSs on this side, because we do get a lot of interest there, and we just are approaching the year end as well. So a lot of subscriptions is something that which is expected in ELSs as well. Mrin, thank you so much for joining us here on Mutual Fund Corner today. It was a great learning for us and all our viewers as well, Pavitra.
Oh, absolutely. And, like all of these topics, like we were talking about, we discussed when you should get in so much, but it's equally important to conduct a portfolio review, to study your own portfolio. And it helps when someone breaks it down like that for us. Mrin, thanks a lot for joining us. But on that note, we're going to wind down on this edition of Mutual Fund Corner. From the entire team, thank you very much for tuning in. We have Closing Bell up next.